Hey everyone, welcome back to the channel. Today I have an episode on a subject that has been timeless in the real estate world. It's one of the reasons wealthier people invest so heavily in real estate. Today I wanted to talk about depreciation. Anytime I have an opportunity to save money on my taxes, I get super excited. There are many things that can be depreciated, but all real estate is depreciable. Depreciation creates a loss only on paper. So there's no cash that actually goes out as an expense, but you still claim it as an expense on your taxes. And for many people, if enough depreciation can be claimed, you can actually bring you into a lower income threshold, which can substantially help you in your tax savings. Depreciation is an accounting method used to allocate the cost of physical assets over its useful life. So, to give you an example, let's say you buy an investment property for $275,000. Now, in real estate, it's typically depreciated over 27 and a half years. Essentially, this means you can claim a $10,000 loss every single year for the next 27 and a half years until that real estate's value goes to zero. It's not like a real cash out expense where if you're replacing the carpet, painting, replacing the roof, where you actually have to spend money to claim it as a loss on your taxes. Now, just for example purposes, let's say you make $50,000 a year. Here's what your tax liability should look like according to the 2021 tax brackets. The first $9,950, you're going to get taxed at a 10% rate. The next $30,574 is going to get taxed at a 12% rate. The next $9,476 is going to get taxed at a 22% rate. So your total tax liability comes out to $6,748 without claiming any other expenses if you make $50,000 a year. So now, if you took a $10,000 loss for depreciation, which is all on paper, here is what would happen to your tax liability. Your income goes down from $50,000 to $40,000. The tax bracket will follow as so. On the first $99.50, you're going to get taxed at a 10% rate, which is $995. On the next $30,050, because we're only going to $40,000 now, you're going to get taxed at a 12% rate, which is $3,606. So the total taxes you end up paying without claiming any other losses or expenses, you're going to be paying $4,601 in taxes. That's a difference of about $2,100. I know some of you may think the bottom line of the money saved here may not seem like much to you, but when you look at the percentage, it's 32% of your tax liability, which is a significant number. So imagine saving 32% of the taxes you pay every year. You can be investing that money somewhere else or just saving it for your next rental property or whatever. It is very, very substantial. I showed this example because the difference in tax brackets between the $40,000 and $50,000 mark are much higher in this income range than the tax bracket differences in the higher income ranges, even though the higher income ranges have higher tax brackets. Now, one thing to note is even though depreciation is claimed while you hold the property, you end up having to pay the money back when you end up selling the property. And this is called depreciation recapture. And it is the difference between your basis in the property and your capital gains that you're earning. Now, I know this may sound confusing and I don't want to overwhelm any of you guys. So I'll explain these subjects a little bit more in detail on my next video. The point is, though, depending on your income, it's good to talk to your accountant or CPA and do some tax planning to make sure you don't get hit with a huge depreciation recapture or capital gains tax, whether it's short term or long term. So, going back to depreciation, think about it. If you're earning high six figures or in the millions, the tax liability is reduced substantially. This is why high income producing individuals always invest in real estate. This is one of the best and easiest ways to shelter your income from taxes. I just wanted to make this quick video on depreciation and explain it in the simplest way I could. I know this topic can be a little confusing, so please feel free to ask any questions or concerns you might have in the comments below. By the way, I'm not an accountant, so you should verify everything that I'm telling you with your CPA, and anything to do with your tax planning should be handled by your CPA. Thank you for tuning in. I hope this video was helpful to you guys, and on my next one, I'll be explaining depreciation recapture as well as capital gains a little bit further. All right, thanks, guys. Is that good? Yeah. But this subject has always brought tingles through my back. I mean, anytime there's an opportunity for me to save a ton of money on my taxes, it'll always bring me goosebumps. How's that?